G'day everyone, I'm Nick Erner, the Managing Director of Alkane Resources, here at the Denver Gold Forum Americas. Alkane Resources is a producer of gold in New South Wales in Australia with a very large exploration copper gold porphyry project as well. G'day mate.
G'day mate. Welcome to the Aussies. How are you?
Yeah, good.
Yeah,
really good.
You're at Beaver Creek. We saw you there.
Yeah, done the double, Beaver Creek and then here at Denver Gold.
It's a long session, isn't it?
But the great thing is you get adjusted to the altitude.
The day you leave. Yeah, I know. Two different, very different formats last week to this week. The others are kind of smaller through to mid, and then this is mid due to going up to the largest. Yeah. What did you get out of it? Is it worth coming?
Yeah, it is worth coming, particularly Beaver Creek for a company of our size.
Yeah.
It's tricky. Obviously, many of the similar investors go to both. So, I had a much more full calendar at Beaver Creek than I do here at Denver. But then I had quite a few investors and sort of broking types here at Denver. I like it because it is one of the conferences that really does just have investors and brokers and that sort of thing as well, right?
Yeah.
And that, you're not distracted a lot with sort of vendor type relationships, which are important as well. I enjoyed it. It's always good to get feedback on what are people looking for in this market, what are people's views, particularly of gold price, right? And the thematics, to be honest, the thematics haven't changed, but quite well received. Quite a lot of people interested. A lot of people interested in talking about what Bodo Kaiser are doing, but a lot of people more interested in just talking cash flow, right?
Well, yeah, I think the same. I think there's a lot of people with a lot of different views about how to play the market, depending on what type of company you are, and some of them may be right, and I suspect a lot of them will be wrong. So you've got to have a very strong view yourself about what the plan is, and we've talked in the past in great detail about what's going on the operations side of things, but quite simply, if you had to sort of lay out for people new to this story, the business plan, the timing thereof, what would that look like?
So two parts. First, Tomingley operation. So we're in the really late stages of developing the new mining area. So we are mining underground at Roswell, and we're about to enter commissioning the paste plant and the flotation regrinder stuff.
Right.
So, and the most important thing about that is we're 85% of the way through our capital spend, right? So that's really good. So we're hitting this inflection point on cash flow that we were always intending to hit, that people should start to see, particularly in the December quarter. We have a tax bill to pay, but, that's looking pretty good. So then, and timing is dependent on, cash and financing, but then we develop the new highway and move from sort of this 75 to 85,000 ounce range, and then move that up to 100,000 ounce range of development open cut. So this is a sort of, we've reached peak one, and then we go to peak two, over the next year and a half after this. And then on Bodo Kaiser, it really is, we're chipping away at all the environmental approval processes and stuff that you need, and doing a lot of regional exploration there as well. But really, the next phase is potential partners into a data room, have a look. People should not get, people listening should not get really excited that there's an imminent process. There's a hell of a lot of discovery, slow-moving people, understanding the project and deposit, because people are trying to work out where does these fit into their plans. They're not, all these majors are not babes in the wood, right? They've got plenty of plans.
Yeah. So if like you're a producer, okay, so I think you get a tick in the box for that high-priced gold environment. You get a tick in the box for that because margins will be improved and your cash position is improved. But the challenge that you're trying to address and you're in transition is the scale component. So again, just come back to the question on timing plans around that, because it's kind of like a lot of companies I've spoken to this week trying to get ahead of themselves. Seems like looking into the distant future and the big blue skies ahead without taking care of business. So give me a sense of timing of these kind of conversations, please.
This is mid-September, right?
Yeah.
So we will be commissioning we're already mining underground. We've got new equipment and stuff like that. So we will be commissioning the paste plant and the flotation circuit in October, November. Right? We want them stabilised by Christmas for all the obvious reasons, but that's just the natural timing. That sees us at, guidance for this financial year is a 70 to 80,000 ounce mark. guidance for next year is, 85 to 95,000 ounces. It's just grade. That's just grade from the underground. That will rise and fall. So next, what we've already done, we've already allocated a contractor to move the Newell Highway, which allows us to do these open cut developments. But that contractor now engages with the government on its own. It has to get its management plans approved and stuff. Everything's approved to be allowed to be done in a detailed design, but the contractor has a validation process for the government. So that work has commenced. In our ideal world, we'll be moving that highway in the March 25 to December 25 period. That may go back a quarter, if we need to from a, financial management perspective. Okay. Then after that, there's a 6-month period. We'll call that start of 26 to the middle of 26, where we do the open cut, etc. During that period of time, we will have expanded the plant. That's just a small expansion. And then we'll be hitting 1.5 million tonnes milled and million ounce. I mean, no, sorry, not a million ounce. 100,000 ounce run rate. So 100 to 110 type run rate. That is from the middle of calendar 26.
Okay.
Right. So FY 27. Yeah. So that's our timing.
Okay. And money during that period, you've indicated there, things may slip by quarter. You've got to manage your capital across that. Are we any need to kind of raise capital? I know probably a lot of people are quite excited if you did, maybe a way of getting into your project.
Yeah, exactly.
But maybe not good for you.
No, I mean, I get, as you can imagine, I get different offers for people to put money in, right? But that's because people see the value, right, at the price that it's at. And, and our liquidities are sort of, well, sometimes they're massive, but, it's typically $600,000 to $700,000 Australian a day.
Yeah.
So, no, there's no need to raise capital.
Okay.
Let's look at 3,800 Australian dollars. You can fund that out of cash flow, right? Yeah. So
I just achieved my athletic goals according to my watch
while
sitting on the bench.
It's the altitude.
You are.
It's the altitude.
Or the exhaustion of just trying to go with the questions. Okay, so because I guess what I'm trying to do is paint a picture of what I'd be investing into by coming into you guys, right? So you're a producer, you're producing cash, you're profitable. I'm going to assume because the prices are higher, you will continue to have a steady state margin. That's not being, well, maybe eaten into, but you're net profitable at over the next 18 months. And your expansion plans are clear. Okay, 100 to 110. That puts you in a very nice category, rarefied air, where I think in the US we used to sort of say, well, those sorts of companies should be around 400 or 500 million USD market cap, etc. So it feels like there's a kind of step change opportunity if you keep hitting these deadlines and you kind of keep hitting those ounce production. What's the downside here? What are the things that you were concerned about not
So the
doing?
downside, I mean, so we have a hedging position because we took our debt out in sort of March 23.
Yeah.
So mark to market, that's 87,000 ounces. Some will get paid in this September quarter, but that's 87,000 ounces. So, gold price, the average price there is 28.40 Aussie.
Yeah.
Gold price now at 38. It's not quite 38.40 today, but call it 38.40. So it's a grand out of the money. So it's 87 million out of the money, right?
Right. Okay.
That's fine because that's, obviously we'd be better if it wasn't, but that's, our cost of production is below that.
Yeah.
Right. So it's cash flow positive. But it does mean that this year when we're doing, quite a bit of vertical development within Roswell, free cash, 60, 65 million bucks at a Tomingley level. There's obviously other stuff. Then the following year, we do sort of 90-odd thousand ounces, but then we're doing much less development. Free cash, 110 or more.
Starting to get useful, right?
And so what investors will see is our cash balance broadly holding flat at this, 35 to 50 Aussie mark as we do the stuff I talked about, and then just bang, that's done and away it goes. So what am I worried about? I'm always worried, and we do a lot of work in the space like everybody. I'm always worried about the health and safety of our employees, right? We're in a mining environment, and a lot of it's reliant on people's decisions of following procedures. The procedure process comes in. So I often, I think every executive you talk to thinks about that all the time. and a lot of that's done good work on the site level. I think gold price collapse would be, ignoring the likelihood of that, we're protected at $3,000 an ounce Australian. So we've got our hedging at 28.40, but we have puts out to 2027 at 3,000 Aussie. So that would be bad in terms of, if gold price collapsed in January, right, then I'd probably push back the open cut stuff. Like you wouldn't spend money when you didn't have to. You'd wait and see that environment correct. So it wouldn't damage the business, but that's always of concern. I think execution risk, I'm not particularly concerned. I think we'll go and commission the paste and the float plant, but if you then look at moving in the highway, we're using a civil contract. We're not trying to do that ourselves. We're using a civil contractor. We're using the same people to do the process plant. So I do worry about execution risk, but that's more a timing thing rather than a cash thing. It's most likely going to be on budget. It might slide a quarter or two. That's not great, but it's not a company destroyer. Yeah, so it's just the usual sort of things, execution risk, stuff. And people, should remember, this is our first, either for us as executives or as a company, we've done plenty of stuff like this before.
And do you think in all of this, because there's a lot of things to do, a lot of things to get over the line. Money's tight. Once the hedging's out of the way, it kind of game changing in terms of free cash flow for you guys, or potential free cash flow for you guys. With the answers are going to come from what you know today.
Yeah, reserves. Yeah,
absolutely. So the exploration is usually where people get a little bit excited if you can say, well, here's something significant addition to reserves. I don't reserve resource. Right now, is that a concern for you, or do you think it's like stick to the knitting for now?
Not really. I mean, we're at we've got very defined plans out for the next 5 years, and then resources out beyond that.
Yeah.
Obviously, we need to convert those resources into reserves, and we want to, rather than letting our reserves collapse into like a 3-year horizon, we want to be maintaining a 5 to 7 year reserve horizon.
Yeah.
One, that's easy to predict stuff on, and it's easy to make investment decisions elsewhere. Yeah. But two, I think if anything requires approval modifications, the game worldwide, you just need to be ahead of that, right? And so having a few more years ahead is a very useful thing.
Yeah.
There are, of course, mines that have, successfully run with 2 years ahead of them for donkey's years, right? Because when you're an underground drill platform, until you get the development out there, you can't drill ahead. So that's a key thing for us. We're about to embark on a series of deep drilling under our San Antonio Antonio open cuts.
Yeah.
That's really that'll be really interesting. So we continue to have sizzle in that space. Yeah. But I think today's investor is really looking at, well, that's interesting, mate, but what's the cash flow over the next 3 to 5 years, right?
Well, it's exactly where you need to get to, because I think you don't have the scale and the life of mine to be attractive to majors and say, oh, come on, we'll take you out and give you a 30, 50, 60% premium.
You need a 250,000 ounce mine, right?
And you don't have that. But, so I should say, therefore, I understand what I'm buying into. I'm buying into in terms of you keeping to drive those answers, keep finding those answers, backfill that, the reserve, etc. And with the cash, you're sort of intimating here there'll be dividends, and I can look at well, there's a dividend company, and maybe it's a little bit of a growth story because the kind of accretive ounce growth there as well. So my stock should do well as well. So if that's what I'm, well, would you say that's what I'm looking at with you guys?
So let's fast forward 3 years, right? What would the ideal scenario be? The ideal scenario would be that obviously Tomingley had done everything we just talked about, and so that would mean in 3 years' time, we're in FY27. There's a 100,000 ounce run rate, and you're pumping out, 150 million odd Aussie at today's prices. That puts you in a position to do a lot of things. Dividends and buybacks are obviously on the table.
Sure.
But also, ideally as well, in 3 years, you would find we had some sort of partner on Boda Kaiser in place, so, and the approvals process had continued.
Yeah.
But then secondly, we would like to have merged or taken over or something, either an existing producer from a merger perspective, or a developer who has stuff that can be developed in FY27 in that time frame. So that's where we'd be allocating the growth portion of the capital. Of course, we do our own exploration and follow that up hard.
Sure.
But I really, we've talked about this a number of times. I really think Alkane should be or be part of a company that's a 3-mine asset, so that this capital, because you look at our share price, we've gone right up and we're pumping out a hell of a lot of free cash. Then we invested that cash in Tomingley and Boda Kaiser. And we come down, and then obviously we're heading into another whole free cash cycle where we should rise again. Ideally, we would have, used that cash versus other operations cash flow and stayed at least more steady and steadily rising, right? Yeah.
So, okay, it feels like there's an opportunity ahead of you if you just keep delivering quarter over quarter. That's what.
Yeah, we absolutely have to deliver now, because if you're not delivering, then you don't have a platform for anything. Yeah.
Good, man. Keep doing it.
Excellent. Thanks, Matt. Appreciate it, mate. Good to see you again.